Hey folks, this is your host Mandeep, and today is Saturday, December the 28th. And what we are going to do today is we're going to look at something slightly different, right? A lot of times, my past videos, I do focus on technicals, I focus on the ultimate trading strategy, and focus on fusion signals, etc. But today what we're going to see is what other things can we add into the arsenal that we have to get a further edge when we engage in day trading or intermediate term trading, right? So the concept that I want to talk about today is the concept of option flow. A lot of people call this as wise guy action, or where the smart money is putting their money, and the ability to follow what these wise guys or the smart money is doing, and tail them. And there are times that you will find sort of a huge advantage. And the reason you find this huge advantage is when people are buying these options and they're sweeping across exchanges. More on that in a minute. The market maker who stays, delta neutral, they're going to sell these options, and when they sell these options to these institutions who are buying them, they're net short. And in most cases, or in almost in all cases, they make money on the bid and the ask, and they stay what's called delta neutral. So in order to cover themselves, they will actually go and buy the stock in the open market. And when that happens, it causes a little bit of momentum in these stocks, and that you can capture if you're trading short term. But clearly, some of these bets work in the longer term as well, and we'll look at one example. Uh, so also another thing that's worth understanding in these option flow is that this option buying happens for a multitude of reasons, right? And there's absolutely no guarantee just because that they are buying that this bet is actually going to pan out, right? Now, they buy for multiple reasons, and one of them could be just placing directional bets, right? So they're bullish on the stock or they're bearish on the stock, and they buy the underlying options on that stock, right, to place bets on at a much smaller cost. That's one reason they would do it. They could also be speculating, right? And that's entirely possible, right? So they're speculating that the stock's going to make this gigantic move for XYZ reason, and they buy these options. They could also be replacing existing stock that they have. So, for example, let's say they own 5 million worth of Amazon stock, right? In which they've made a substantial, money. Now, what they can do is they can sell those, equity, and they can replace them by options with a much smaller sum and still be in the game. They can also be using these, option flow for hedging. So, for example, if they're long, let's say, millions of dollars of a particular stock or a set of stocks, they could buy puts on the SPY or other instruments just to hedge themselves, right? So in theory, you would never know what the underlying intent is of any of this option play, and the only way you would know for certain is if if this person is known to you, and you can go ask them, why exactly did you place their bet. Other than that, there are some cases, you will be able to see um, that these truly are directional bets, right? And the ones that actually make it really interesting is this concept called the sweeps here, right? So a sweep happens when there people are buying these options, and they're sweeping across multiple exchanges. So there are, if my understanding is correct, there are 16 exchanges in the US. So there are times when they're sweeping on on more than one exchange to get their quota filled, right? And the reason it happens is because when you're on a particular exchange, you may not have enough stock available or enough inventory on that particular exchange to be able to fulfill what you need. But once you start sweeping across multiple exchanges, it also shows urgency on your part, right? Or the urgency on part of the institution that they really want to get their hands on this particular equity, or in this option, and they want to do it very quickly. The other reason why they do it is also because they're buying like much smaller lots, right? And if you look at those lots, to an untrained eye, you may think it's fairly normal. The size doesn't seem too big, but when you add them up together, it's a substantial sum. And I'll show that to you with one example on Amazon. And although this example is in the past, you are always learning, and me included, of how this can actually be extrapolated to what you can do in the future. And we look at what's happening on some of these stocks, on some of the bets that people have placed that are into February and into March as well. So today, let's just start with the example of Amazon. And one of the things you can do is, this is an app called Flow Algo. There's a company called Flow Algo, and I have a subscription to it that provides you this data. But there's other places where you can get similar data, where you can see the option flow that's going on. So when you can filter on Amazon, and you can see what all traded. So you had a bunch of, you had a few puts, and a majority of them were called, and these were, some of them were blocks, which oftentimes could be just replacements for equity that they own. But what we want to do is, we want to be able to see what they did in the past, right? A little bit of a history on this might further help us understand what their mindset is. So one of the things we can do is, we can click on this historical flow here, and then again we can say we want to export this data. So let's just click on Amazon. uh, Amazon here, and then we'll look at this data from the beginning of the month. So let's look at from 12/1 to let's say Friday, and say get data. So we get a large set of data. What we're going to do is, oops, this should be 12/1, and this needs to be 12/28, let's say, and say get data. So now we have a much larger set of data here, right? But it's just kind of hard for me to analyze the data in its current format. So what I'm going to do is, I'm going to export this into a CSV file here. And let's open the CSV file here. And for whatever reason, no idea why it shows it vertically upside down, but now we've fixed it, right? So now let's just create a filter on this by clicking on the filter here. So now you can see this data, but I'm not interested in blocks. The only thing I'm interested is in the sweep. So what I'm going to do here is, I'm going to get rid of the blocks and the split, and I'm just going to look at the sweep. So I'm left with a much smaller sum. The other thing we can do is, we can also filter these by, like, let's say the expiration date, and let's just make it ascending. It really doesn't matter which order we do it in. Now, something that I found interesting was, look at the date of expiration date of 2/21, and there were a number of these calls that were bought, and they were actually all bought on the same day, 12/6, right? So let's just filter this a little bit further and say, um, uh, we'll filter this a little bit further and say, just show me just the strike price for uh, I want to get rid of all of these as well. The only thing that I'm interested is the 1820s, right? So that gives us a little bit more, concise information. So the interesting thing to note is, on that particular day, the only open interest was 168, and whatever the syndicate was doing was, they were buying all of these options, and they bought them in lots of 59, and they were sweeping them across exchanges. So they didn't buy all of them right from one exchange, but they bought them from multiple different exchanges, and all of them had the expiration of 2/21, right? And all of these were 1820 strikes, right? So that tells you that the likelihood is that all of them kind of belong to the same sort of organization, or the same institution. So, they obviously split the price up, but one of the things we can do is, let's just do an auto sum and see, and we'll format this if we can, and turn this into the currency, and say, okay, so they spent roughly $3.2 million on this trade. So that's pretty substantial. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11 of these, right? So let's say, we sum this up and see. So the total was sum. So what's the average price equals this divided by 11. So the average price that they paid for was $54.90, right? What they paid for this is, so this is what they paid for it. And if we go back and look into the actual expiration, and gently, I might have to restart this. So while this is restarting, I'll continue on the other discussion that we are having. So what we'll do is we'll take a look at that in a moment. But so they spent roughly $3.24 million. Since I looked at it already, I'll tell you what the price was. So today the price of this is uh, about 106. So you can do the math, or simply if you want to do the math, you can do it right here. Oops, profit. Now this will be equal to, let's just call it open parentheses, which is about 106.50 is the average, what it is currently trading at right now, subtracted by the average price they paid for it times the shares they own, right? Uh, which is apologize, I did the math a little bit incorrectly here. So this is not, this is the total number. So this is where the actual price is. So we'll sum this up here, and we get 590, and so the average equals 590 divided by 11. So that gives us uh, 90 divided by 11. Gives 53. That's what they actually paid for it, right? So let's just get rid of this and we'll restart this again. So this is equal to 106.50, which is what they paid for it, subtracted by 53.71, multiplied by the total number of shares, which is 604 times 100, which is each contract is 100. And it contains an error of 53.71, and you can see this is the profit that they made on it. Let's just format that and expand that a little bit. So in other words, they put in 3.2 million of initial investment, and they're currently already at 3.1 million in terms of profit, right? So obviously we're talking a little bit in hindsight, but these kind of things happen all the time, right? And if you can keep track of this and see what they're sweeping on, sometimes it helps you sort of focus on those stocks as well. So meanwhile, let's just log in, and we can take a look at how the stock ended up performing on that particular day. And we'll just, in the meanwhile, we'll just go back into the application itself, and we'll say, okay, this I want to see what happened on another stock, um, and we can focus on Sharp. This caught my eye the other day. And one of the things that was interesting is that this was yesterday, which was Friday, and there's a week left, right, and the expiration of these calls, and they were buying a lot of like these 440 calls, right? So that kind of was interesting because they're laying a fair bit of premium out for these. Now, as I said, just because it worked out for Amazon, doesn't mean it's going to work for this. However, as full disclosure, I actually did take up a position on Sharp, and so I actually didn't take the options expiring on the 3rd of Jan. What I took was January the 17th, and so instead of doing naked calls, I ended up doing a spread, which is I took the 420, 450 spread, and I only put in the amount of money that if I even if it goes to zero, it doesn't sort of impact me. So the important thing to emphasize is that you should always size up your position correctly, even if you're doing options, right? A lot of people use the thumb rule of like, okay, if it goes down 20, 25%, they'll bail out, and oftentimes I've realized that in terms of options, sometimes overnight news may drop the stock down substantially, and and then it gets too late for it to recover. So one of the things I do is I only put or lay out the premium that I'm comfortable losing, right? Okay, so now that we have this, what we'll do is let's just take a quick look at um, the Amazon trade. And what do you see here, right? This is when the Amazon long got triggered, show report, and let's see how much profit. So this one generated in 2 days, right, $7,895 in profit, and shows you the exact entry using this. So you entered the trade on 12:26 at 6:45 p.m. Pacific Standard Time and exited on 12:27 for this much profit. And the total profit loss on this Amazon for the last 30 days was about 10 grand using the ultimate trading strategy, right? So what I end up doing is, like as you can see, there were a couple of trades that were about even, right? But so that's fairly normal, right? I mean, the idea of a automated system is that you win big, but when you lose small. So either you break even, or you maybe gained a little bit here, but here in this trade you gained a lot that offsets everything from previous trades if they were sort of against you. So that's how the UTS um, helps out. So I obviously didn't place the trade when they placed the trade, but that trade was in the back of my mind. But each time the buy was triggered, I actually took it. So that's how um, the flow of options helped. So we'll see how this particular one pans out, but we can take a look at some historical flow on Sharp and on Snap, because these were the two that kind of like caught my eye. Snap in particular, they were. I will again look at a month of data, but I'm not going to export it or anything. So 28th, and do a search. So as you can see, there was a lot of calls that got bought, right? There was like maybe a handful of puts, but everyone seems to be really bullish on these calls on for the 16th. Now, one of the things I do sometimes when the stock is kind of inexpensive like this, instead of placing an option bet, I might just take an equity bet, right? So if you do an equity bet, then I'm not so concerned with getting the timing right. Now, also remember, these guys, they can afford to lose a lot of this money, right? Even if it goes to zero, perhaps they're not as impacted as we would be. So no matter what you do with options, make sure you size your positions properly. So hopefully this was a good example that showed you what the power is of option flow. You guys have a wonderful holiday. I'll talk to you soon. Take care. Bye bye.